discussion on the precious metals price outlook. To moderate the session, may I request Mr. Jordan Eliseo. Jordan is General Manager at ABC Bullion. Welcome, sir. Joining him in conversation is Mr. Bart Melek. He's a Global Head of Commodities and Market Strategy at TD Securities. And Mr. Bruce Ikemizu, Representative Director at JBMA. And we already have Nikos Kavalis. With this, I hand over the session to Mr. Jordan. Over to you, sir.
Thank you very much, and thanks, gents, for taking the time. Nikos, that was a great overview of where the market sits in terms of supply, demand, some of the macro and market factors driving gold and other precious metal demand. So a really good way of, almost unofficially kickstarting this session. I might actually turn my first question to you, Bruce. Obviously, Bart and Nikos, you can comment as well. If we look at where markets were as of this morning, we're almost exactly 6 months through the year. Gold's at 3,400, silver 3,650, platinum just over 1,200, and palladium just over 1,000. On balance, precious metal markets as a whole, would you say they're higher, about in line, or lower than what you would have thought at the start of this year?
Well, of course, this is very much higher than I had expected. I just got an email from JBMA this morning about assessing our forecast, which we handed in at the start of the year to the JBMA. And I just very good timingly. I thought my forecast this start of the year, the gold market was like 2,600 at the start of the year. And my forecast was like 2,500 was the bottom, and the highest price we would see like 3,100. So by April, the gold went up as high as 3,500. So my forecast is already very far out of the mark. And I would say I won the prize. I won the prize 2023. And I was bullish enough, so I could win the prize. But last year is, as Nikos said, 2024 was very strong market, and the market is above all analysts' expectations. And this year is going to be like that again. So I think, and I have to reforecast my forecast, and I think gold still have a long room, huge room to go up from here even.
Fair enough, thanks for that. And Bart, your view on the market so far this year?
Well, certainly, I think for the most part, there was a lot of upside surprises, but I think one that surprised me the most, and where we were, for the most part, wrong, is platinum, which I think took everyone by surprise. We were seeing a squeeze on the front end and a lot more demand in China than I think anyone thought possible. So that was the big surprise. Of course, gold going to 3,500. We were positive gold for a long time. But clearly, I didn't think 3,500 was in the cards. Certainly not this year. In contrast, we were a little bit more optimistic on silver than where silver is now. Our view was that the squeeze might come a little quicker. But what we didn't anticipate is tariffs and the impact on industrial demand that was going to have. But for the most part, I think these markets are higher than we thought, though we were in very bullish mode to begin with. But the magnitude of the increases, I think, is unprecedented and certainly was difficult to forecast.
For sure. And Nikos, obviously, you sort of alluded to it at the start, even in your slides, but I guess you concur.
Absolutely. We really did not expect the extent of rallies that we've seen. For gold, we were moderately bullish on platinum, but we were looking at 1150, maybe 1200 by the end of the year rather than within a few weeks, or well, within a few months.
Sure, sure. But I might actually turn back to you. You touched on silver, and we were talking a little bit about that yesterday. Is that probably the precious metal that's really stood out? And is there any particular element of maybe the demand picture or the supply side that's piquing your interest right now?
I think what we've seen is huge movements of silver from the LBMA system into New York on anticipation of the tariff, and that certainly is reducing the liquid availability of above ground inventory. And what we're looking at is the long-term structural deficit and a positive demand picture down the road. And that is despite of the fact that for 60% of the demand, things in the short term aren't looking so rosy as potentially we're going to see a slowdown, a significant slowdown in the United States, as China, I think, is going to struggle to, hit 4% GDP growth. And despite of that fact, this market is quite tight and will continue to be so. The problem is there's 500 million ounces sitting in the CME stores right now, so I think that squeeze may not materialize anytime soon, given the industrial outlook. But certainly, a year from now, assuming a lower rate environment and a better environment for just broad demand, we could certainly see an environment where there isn't that much available metal to fill the gap between primary and recycled metal and demand. It's going to take a couple of years to fully be eliminated, but then we're going to be in a situation, I call it an auction price environment, or demand destruction is going to be required to balance that market.
Sure. I think, Bruce and Nikos, obviously if we go back to the first question, I think everyone's, as a whole, been incredibly impressed and surprised to the upside in terms of how precious metals, in aggregate have performed. But is there one metal in particular that stood out for either of you two this year? You can go, Nikos.
I mean, gold.
Gold. More than silver, more than platinum.
Without a doubt.
Right.
I mean, it's the appetite that we've seen by investors for gold has been astounding. I mean, the fact that you're seeing all-time, Bruce is based in Japan and he'll tell us more about it, but the fact that you're seeing all-time record after all-time record in a market like Japan, where traditionally everyone's buying dips and selling peaks,
rallies, yeah.
Selling rallies. I mean, you're seeing Asian investors across most major markets chasing the price up. I mean, it's I would
historically
say,
unusual.
Yeah, I would say it's definitely gold that stands out for me.
Sure. Bruce?
Yeah, same. I mean, just as Nikos mentioned, we are seeing a very big change in the investors' attitude in Japan. It used to be, we are very bargain hunters. When the gold dips, we go buy the dip. But when the gold rallies, people are queuing on the retail shops with their gold physical in their back and literally making the queue to sell the gold.
Right.
But these days, even like yesterday, we had a new record high in yen term gold, which is above 16,000 yen per gram. But I talked to some of the Japanese retail guys, and they say, no selling, but buying is bigger than the selling.
Sure.
At the highest prices in the history, which is a big change. I think lots of people are buying, starting the gold accumulation plan and buying physical and also gold ETFs. They are really, especially younger generation is now considering this, weaker yen and inflation is really a big risk for them, because if they don't do anything, if they just have Japanese yen, their wealth is, their money is really losing that value.
Yeah.
So for them to, for us to have yen, gold in yen is the best protection for that losing value. of the money. Yeah.
Makes sense. Obviously, let's call it the last week as a whole, geopolitics and what's happening in the Middle East has been front and centre for all markets, including precious metals, although the last day or so the actual returns have been quite muted. Do you guys think that sort of geopolitics piece remains the primary driver for the next 6 months, or do you think it sort of shifts back towards tariffs, trade, maybe what the Fed is doing with policy? You want to start that one, Nikos?
Sure. Look, geopolitics is unlikely to go away as a backdrop. I do hope that the kind of heightened tensions that we're having at the moment are going to dissipate, because if they don't, we have bigger problems than gold.
Of course.
No, look, I think the macro side is it's going to be a far more decisive factor. And I think the concerns about the US debt situation is really, in my mind, the single most important concern at the moment.
Sure. But did you want to flesh that out a bit? I remember you talking yesterday a bit about that. We were chatting offline.
Well, I think geopolitics aren't going away. It's a multifaceted spectrum of influences. There is, of course, the most recent one, the Middle East situation, where we're not quite sure how that's going to go, how it's going to impact oil markets and inflation. And of course, there's the long-standing structural one, the relationship between the United States and China. Those are just the big key ones that are influencing gold, for example. I think those emerging U.S.-China tensions are, in my opinion, very much driving the interest of Chinese central bank to diversify their portfolio, and that I think is going to stay here for the foreseeable future. The Middle East, that's a tough one. It could last a month, a week, or a year. But the big influence is there. To what extent does it impact oil, and does that conflict broaden out into the region? Either way, geopolitics are here to stay, and they will prompt investors to diversify their portfolios. And in the Middle East case, it's a situation where we could have inflation already being elevated due to tariffs in the United States, and then an energy overlaid on it, and a weaker economy, and probably a Federal Reserve that's easing.
Sure.
And what does that mean for gold? Probably good things.
Sure. I say that's 4 or 5, perfect tailwinds almost combined.
Yeah.
Even if at least a couple of them are very, sad that they're there in the first place. Bruce, anything from your side?
Well, yeah, this just overnight. I was very surprised that yesterday we didn't. In the morning, opening of the Monday, we went up to 3,450. Mm-hmm. But after that, gold just comes off to, at the moment, it's 3,380 or something like that. With this Iran-Israeli bombing, I was kind of shocked to see, because my forecast for this conference, yesterday's fixing, the JBMA gold price was much higher than the real one. But I think people are kind of get used to this situation. And what I was surprised was the Nikkei stock price yesterday was quite strong. Just right after this incident, I thought Nikkei could be sold 500 or 1,000 points, but it went up to 400 points. So I think that kind of protected the market. And New York also stock market quite strong. Quite steady yesterday. And gold was sold because, like me, I think people bought gold before the weekend, for expecting something would happen over the weekend. But so I think the investors are a little bit get accustomed to this short-term geopolitical crisis.
Yeah, that makes sense. I'll jump in with another question in a second, but just for everybody in the audience today, we will have time for some audience questions using Slido. So if anyone wants to sort of get some ready now, I'll get to them in the next few minutes. The next one I wanted to touch on is the scenario around real rates. So obviously, from early 2000 through to really 2021-ish, there was a fairly strong relationship between gold and the real rate on US 10 years. That's really broken down since the Russia-Ukraine invasion. Do you think that relationship is essentially null and void and will remain so for the foreseeable future, or do you think that the gold price sort of recouples with rates in due course?
Well, I think the 2024, last year or 2023, the American interest rate, long-term interest rate, 10 years went up to 5%. But while it went up to 5%, gold also went up. So we were talking about this mysterious rally, and there's a mysterious buyer in the market. But if you think that this the moving away from the dollar, especially from Chinese central bank, they're buying gold and selling a U.S. bond. So it 100% explains that higher interest rate and also higher gold prices. And I think this trend will continue. We not easily go back to the days in the past. What do you think?
Bart,
I fully agree. I don't think gold has decoupled from real interest rates. I still think that is very much a fundamental driver. It's just other factors have overpowered that effect. And, certainly physical buying in Asia was profound. Central bank purchases of over 1,000 tons of official sector, rather, since, 2022 has overpowered that movement. We had gold not that long ago trade above $2,000 at a time the Federal Reserve was pursuing the most aggressive monetary tightening in 40 years. So, that speaks to a fundamental rejigging or reorientation of the financial system. Bruce just mentioned de-dollarization, and I think that is something that is happening. The big concern is, will the U.S. dollar keep its purchasing power? If I have trillions of dollars of treasuries and other U.S.-based assets, denominated assets on my balance sheet, will that buy something 20 years down the road? Given that U.S. debt is $37 trillion and growing at a rate of 6%, and now we're talking about legislation that would cut taxes and make that deficit even larger. The question is, with Social Security, Medicaid, and in other social programs, how do you fund it? Well, people don't like paying taxes, and that's probably not only unique to the United States, but globally. But you're going to have to pay the piper, and one way may very well be a kind of de facto monetization where you pay through inflation. You print money, and somebody pays by reduced by reduced purchasing power. And I think that is what gold is responding to, even though the real rates were, working against it.
So it's not so much that the relationship's broken, it's that it's no longer anywhere near the dominant driver of the market. Nikos, jump in.
I would also, if you think of it from a model perspective, I think if you look at the correlations, certainly on a short-term basis, whether you can see that gold still responds to rates, whether sometimes it's stronger with actual rates, sometimes it's stronger with if you create a gauge of rate expectations. But I think the way that I think of it is rates are one of the factors that are contributing, and there are some exogenous factors that have basically lifted the whole baseline of where gold stands versus interest rates. And although on a day-to-day basis there may be a response, the fact that we've had 3,000 tons, more than 3,000 tons of central bank buying in the last 3 years, that has lifted the whole baseline up.
That makes sense. Jump onto the central bank piece next. One last question just around, I suppose, gold's relationship with other assets. Given the relationship with real rates, to your words, no longer a dominant theme. It's also obviously had a very strong negative correlational relationship with the US dollar. It's had this historical relationship with the stock market that it tends to do very well when stock markets sell off. Do you guys see any of those other relationships potentially at risk of changing, or you think those factors will remain as they are for the foreseeable future? Bart, do you maybe want to start that one?
Yeah, sure. Look, we've seen examples of where the market is in a risk-off mood. People end up buying gold as a hedge, but they also tend to buy, U.S. dollars as a hedge as well. Certainly in the short run. That, I think, continues when we look at data, and that's, well over 40 years worth of data that we looked at. There is a strong relationship, the inverse relationship between equity market performance and gold. The non-commodity markets, like the S&P 500 or so, will have a well-defined inverse relationship. So when they do poorly, gold tends to do well. A market like the Canadian TSX, which is weighted heavily in gold, has a correlation that runs along with gold, which makes sense. So I don't think that's going to change. But we're, with the very strong participation of physical players and Asian demand, we're seeing Chinese ETFs dominate purchasing of late. That is changing the structure where, in that multi-variable world, other factors are becoming stronger and more dominant. Doesn't mean the other ones don't matter. They're just being overpowered by other factors. How long that lasts, we don't know, but probably for a decade, I would say, because these programs, for in case of China, officially, I think, if I stand correct, 6.2% of reserves are in gold out of 3.2 trillion. Well, you're not going to do that in a year to, let's say, get it to 20% for, some sort of level of diversification. It's going to take many, many years to do. And other central banks, are kind of replicating this as well, even European banks like the Central Bank of Poland, for example.
Makes sense. Nikos, how about you? Are there any other sort of areas of the gold market, historical relationships that you're looking at with particular interest?
I think the very interesting thing is that while all the points that Bart made about the inverse relationship, or it fluctuates from inverse to no relationship, like insignificant correlation between equities and gold traditionally, we've actually seen gold and equities rally at the same time in the last couple of years, and I think this is personal view, right? I mean, my humble view is that this reflects the fact that gold has proven itself to be an excellent diversifier. So more and more mainstream investors that are holding most of their portfolio in equities, they will look to gold as a diversifier. And I think we'll be seeing more and more of that, more and more of, and I think in this environment, whatever happens is good for gold. So equities go up, gold is bought as a diversifier. Equities go down, gold is bought as a safe haven. So I think we're in a very unique, sort of once in a generation kind of time where all news is good news for gold, which also creates some risks, right?
Sure. What's that old saying? If everyone agrees, they're all wrong. Is that because Bob Farrell's 10 rules of investing or something like that?
But that is a very good point Nikos is making, because gold may be overbought in some situations, but it's under-owned. The proportion that people hold in gold relative to their fixed income and equity positions is tiny indeed. And I think the narrative that it's a diversifier of portfolios and, because of its inverse relationships, may actually, augment your portfolio performance is a good point. So, it's a good environment in every situation, which is kind of unique.
Yeah. Bruce, I wanted to turn to you. We've touched on it briefly so far, but the ETF market now, historically, the ETF market, in terms of where the flows were coming for, was very much dominated by inflows in America and in Europe. The sort of Asian listed ETFs were getting a much smaller portion of demand. But that seems to have changed this year. There's a much bigger portion of ETF demand coming in through products listed in Asia. Do you have any comments on that?
Yeah, well, it's like China in April, they bought a lot of gold in ETFs. And also Japan is, same thing is happening in Japan as well. I mean, in 2024, the global gold ETF decreased its balance, but Japan is just going higher and higher and higher. I think, just as Bart said, the people are looking at gold as more, the better diversifier as their money. And I am saying that at my investors seminar that, if you look at the gold and money relationship for a long time, let's say 54 years since 1971, the gold was $35, now $3,500, 100 times higher, which means dollar's value is 100 now. If you look at
what it was.
54 years ago. So I think that's the value of the gold. So which would not change for future. I think it's going. The fiat money is printed, printed and printed. So the volume of fiat money increase is much faster than the gold real volume. So I think, I really am a believer of gold.
Sure. It's interesting you say that. We were all talking yesterday about this. Is there an element that we, for want of a better term, almost overanalyze it? Like if we are in a world, and we are, where fiat currency creation is running at fairly high levels and looks set to remain so, we are in a world where federal debt levels and deficits are, the debt levels are at record highs, the deficits look effectively unclosable. Is it kind of as simple as, well, while we remain in that world, you sort of can't help but be bullish gold to a degree? I don't know, Bart, do you want to maybe take that as a starting point?
I think increasingly that's the case. And the question is, why gold? We've seen historically, as Bruce has mentioned, that move from 35 to over 3,000 now. And there's good reason for it. One, gold has intrinsic value. You can hold it and it's worth something. You can debate whether that's correct or not, but we've been liking it for 5,000 years or so, and probably over the next decade or so, that's not going to change. But I think one important thing about gold is it's a real asset that requires real labor and real productive capital to produce. And we know, from our work that over a period, the price of gold has been followed by, has been reflected by, it reflects marginal cost of production. And if you imagine inflation happening, at some point, labor costs go up with inflation, so do productive capital costs. And almost by definition, the marginal cost of production increases.
Sure.
And to that extent, gold's values rise with inflation because it just, you can't print it, you have to produce it. And as ore bodies deplete, you're going to need more of those labor and capital units to produce every ounce. That almost by definition means that gold might even outperform inflation, and therefore and if you're a believer of monetization of some form where governments try to keep real interest rates somewhat lower than they should be, it could outperform bonds, and it's a very good argument to own gold, and that's why it will likely keep its value over some form of debt, which you have to rely on the good graces of the debtor to pay up, and they may not in real terms.
Nikos, we'll turn to a question from the audience in a second, but I just wanted to get your comments on the debt piece and the monetization piece.
I would say that it's not just gold, though. Hard assets all around have been doing much better than currencies. If you look at it this way, how much are they worth in terms of currencies? I mean, art has been doing extremely well. Property, if you compare, if you compare multiples of how many annual salaries you would have to spend to get a 2-bedroom apartment in your city 10 years ago compared to today, it's slightly different. So gold is one of these assets, and the difference between gold and art or property is that gold is very liquid.
Sure.
So
And homogeneous.
it has this, yes, and homogeneous, fungible, etc., etc. So it has all the hard asset properties. Plus, when times are tough, you can just liquidate it and pay rent.
Yeah. Actually, that's an interesting point. We've at ABC Bullion in the last couple of years, we've seen obviously a huge increase in turnover on both sides, both clients buying, but also clients selling back, and that makes sense with the Australian dollar gold price above 5,000. But interestingly, in almost all of the conversations with clients that are selling, it's not because they actually think the price has peaked or they don't want gold anymore, but their gold position's gone up so much, it's now such a big part of their portfolio, or they might still have some debt, which is now costing 7% rather than 2%. And so it's much more about they're making the decision based on a kind of like whole of portfolio, whole of wealth decision, rather than, I think gold's topped out, so I'm trying to catch the top of the market. So I think that sort of dovetails in with your observation. I wanted to jump to central banks, and I had a couple of comments on it, but there's one here from the audience, so let's start right there. Can you name one good reason why central banks should stop buying gold?
They have too much. If they have too much.
So if they have too much.
Yeah.
Bruce?
Well, I cannot really think of, because they don't have enough, I would think. I mean, especially in emerging countries, right? I mean, okay, European countries have like 60, 70%, but emerging countries still, like China is still like 6%, right? So I cannot really think of any good reason to not to buy gold from US dollar.
But
I can certainly imagine, make up reasons, like outsized deflationary pressures or something like that, or regulatory changes which would mandate the non-ownership of gold by central bank. But other than that, I think the environment is quite ripe to actually grow it. And it's been very interesting that now gold makes up 20% of aggregate central bank portfolios,
reserves,
outpacing the euro, and that is quite an interesting development. So gold's been gaining at both the expense of the euro and the US dollar in bank reserves, central bank reserves, and I think that's going to continue.
Well, it's interesting you note that because, obviously the ECB had that. It was ECB that published the report themselves, noting that essentially euro assets had been overtaken by gold, and pushed down to the bronze medal position, as it were, for now. And actually, there's some interesting facts in that are probably worth talking about in the context of the whole central bank demand story. So obviously we've seen, net buying for, let's call it 15 years now since the GFC. The last 3 years have been over 1,000 tonnes each year of net buying, and the total number of, or the total tonnage held by central banks globally is now estimated to be at 36,000, which sounds very high. 15 years of buying, maybe are we towards the end of the trend, some people would ask. But actually, if you look at the data, central banks as a whole owned 38,000 tonnes 5 decades ago. So if you think that 36,000 tonne number now is lower than it was then, proportionally given the size of the global economy, the amount of money in the system, you name it, it's actually arguably still quite a low number, which is kind of your point, Bruce. One of the questions I had for you guys was, if you look at the last 15 years, it's mostly been a case of emerging and developing market countries trying to play catch up to developed market countries in terms of the share of assets. Do we think that that's basically how this game continues to play out? Or is there even a chance that developed market countries start adding to gold reserves as well? Nikos? Or?
I think it's unlikely because most major developed country central banks have the legacy of the gold standard, right?
Sure.
So they
already have enough.
They already have quite a lot, and I think it's very hard to argue that it's wise to start buying gold if you hold 60 or 70% of your reserves in gold already at current prices, right? So we wouldn't expect that.
So you think it stays a sort of emerging?
I think it stays emerging, or maybe countries that stop being emerging markets and become middle income or developed markets, but still don't have gold reserves because of not having the legacy of them.
Sure. Bruce, how about you? Your views on that?
Well, I just say Japan should.
Should
well,
buy
we
more.
have only 850 tons, and which has not changed for decades. I mean, 50 years they haven't changed it at all. And well, I suppose we have very firm the political reason not to sell U.S. bonds. And
Sure.
we cannot sell U.S. bonds and buy gold, you know. That's just, especially now, we cannot do that. But I really think, as a Japanese, we should really diversify our portfolio more to the gold.
Sure. And Bart, your views on the central bank piece?
You know, I agree with Nikos here. Germany, Italy, the United States already have an outsized proportion of their FX assets in gold, so they're probably not doing it. You know, countries that were lower middle income, like Poland, that are moving into the higher income, are actively building. So that's very likely. I mean, you know, about my own country, Canada, we have no gold in reserve, and I agree with Bruce here. We should have some as well. Whether we do,
You have quite a lot on the ground, right?
but yes, but then you know you have to get it out.
Sure. I might cut in there for a second, because that point there that you raised, Nikos, that in Australia, the Reserve Bank sold most of Australia's gold reserves in the late 90s. And there were FOI requests, and the memos that underpinned the decisions are all publicly available. And that was actually one of the arguments that they made about why Australia doesn't need to hold much in the way of official gold reserves. We're like, well, we're the second largest producer. We already have this, for want of a better term, national exposure through our mining industry and the reserves in the ground. But what do you think of that, Bart? As a Canadian, are you comfortable with that or not so much?
Well, you know, I'd like to actually see it in bullion form in a vault somewhere.
I know a refining you can speak to.
You know, because the gold that's mined is mined by private companies, and then you would, you know, I don't know how you'd have to buy it at a market price, and if we expect gold prices to continue moving higher, you know, over the years and decades, you know, it might be quite expensive to build that portfolio, you know, unless. You know, you'd have to pass legislation and do all sorts of things, but you know, that's probably not the way of doing it. So you know, that's a fake argument that you have in situ gold. You don't, because you don't own the gold as the central bank. Private mining companies have it in their, you know, certainly within our system, they can sell it to whomever they want.
Absolutely. Just turn to another couple of questions here from the audience. So. One of the questions, lots of talk on silver, but yet to see it hit the gold-silver ratio of 60. It's probably closer to 90 right now. Your views on that ratio, and I guess the potential for silver to outperform gold. Nikos, do you want to maybe start with that one?
Yeah, look, I really like silver long term, but no, I don't think in the near term we're going to see 60. I think there's actually a risk that we're going to see 100 again.
Right.
Because you know there were quite a lot of inflows into silver. I think the reason why silver has underperformed gold is that we're in a world where precious metals are looked at as diversifier against, you know, systemic risks, geopolitics, macroeconomic disasters potentially happening, and in that environment, gold is very clearly a far more compelling asset to own, and also. Many of the, let's say, more mainstream investors, they may contemplate, and I'm talking about professional hedge fund, institutional investors, generalist investors, I mean, they will contemplate gold, but, you know, silver is far too exotic. So I think in this environment, until silver's fundamentals really start kicking in, I think it's understandable why we're at 90 to 100 rather than 60 to 70.
60 or 70, 60, yeah. Absolutely. Bruce, your views on that, and maybe a little comment on silver in Japan, demand in Japan?
Well, yeah, I mean, about the gold-silver ratio, I was very short at 90, and I was blown off at 100.
Right.
Yeah, I think, yeah, the 90 to 1 or 100 to 1 in silver is really cheap. But I think as Nikos said, well, investors buy gold, central banks buy gold, but they don't buy silver. So I think this situation will continue, and rather, I mean, we rather than we go back to 60s, but we go above 100 again. So I'm turn my position long on the gold-silver ratio. In Japan, we don't, well, most of the investors, again, buy gold and silver, but there are some people who really love silver and who are really kind of frustrated. But now, $36 is, if you look at the past prices, it's very high now. So people are, feeling comfortable about silver longs as well.
Bart, you had some interesting comments on, the setup for silver earlier. So what's your view on, where that ratio moves this year?
This year, I frankly don't see it anywhere as 60. I think, we do see silver, perhaps a little higher where it is, but the problem for silver is that it is relative to gold, that is still a very much an industrial metal. And we do have 500 million ounces sitting in COMEX vaults. That squeeze that we were often citing is unlikely to happen. My understanding is that there's still a lot of byproduct silver in Asia from Chinese smelters that are looking for a potential home that's typically consumed domestically. So it's going to be tough. Longer term, given a structural deficit, given the increasing demand, particularly for solar panels, increased loadings for computerized vehicles, which they all are now, 5G infrastructure build that we're going to use more and more silver, I think will ultimately exhaust those above ground stocks. And we are going to have a problem with balancing supply and demand, and these are physical markets, so you will get higher prices, but that could take 2 years before that materializes. So we do think that silver outperforms gold, but just not quite yet.
Not to that quantum that is implied by the ratio falling back.
Yeah,
towards
I mean,
60.
I don't like ratio. It's kind of a trader fake comparison. It doesn't really reflect anything real except some histories. It's not based on fundamental cost structures or anything like that. But ratios are nice and simple, and we say, hey,
you can draw a long-term chart.
100 is cheap. 40 is expensive, but how meaningful is that really?
Yeah, no, that's a fair point. Okay, so there's 3 minutes left, which means we've probably got time for one last question. So that's probably a good follow-on for this one. And I'm not asking for a price prediction per se, nor necessarily a performance figure, but if you could only pick one precious metal to own for the next 12 months from a performance point of view, which one would it be? And if you have any comments as to why, feel free. So Bruce, maybe I'll start with you, and then Nikos and Bart.
Well, I think, of course, gold will be the champion. I mean, the 1 year from now, next year, APPMC, if I say the price, I would expect gold to be like 4,000. Platinum, hopefully 1,500.
Okay.
Silver, $40. Yeah, I thought I'm bullish on all the metals.
So you should buy platinum then. Bigger percentage increase.
I'm long all the metals.
Nikos, how about you?
Yeah, I would probably also say gold. If you had asked me 2 months ago, I would have probably said platinum because I thought it was a bit undervalued, but I think now it's gone up a bit. It's a bit toppy.
Run.
Yeah, I would, I'm not as bullish as Bruce, as everyone saw in our earlier slide, but I think we're still projecting 3.7 or 3.8. I should know this, but I forgot. Which is pretty good upside, and I think better than what I would expect for the rest of them.
Fair enough. And Bart, over to you to close it up.
For us, for the balance of the year, it's gold. We're looking at an average price of 35.50, and given the volatilities that happen in the gold market, we could easily see a trading price of 3,800 or so. So still silver for the reasons I mentioned, is going to have a problem reaching these 40+ levels this year. We'll see what happens with the economy for next year. But I'm with Nikos here. I would have loved to say platinum, but it already moved. So and we didn't catch it. I was positive, but nowhere near as positive as things are turning out to be. So I think it's gold for me as well.
Right. Gold, the unanimous winner then. Gents, thank you so much. I've really enjoyed the conversation. I hope everyone in the audience has as well. That pretty much brings us to the conclusion timing-wise. So thank you, Bruce. Thank you, Nikos. Thank you, Bart. And yeah, thanks everybody for your time and attention.
A round of applause for a wonderful session.